You're thinking about owning a trucking fleet. From the highway, the business can look almost mechanical. Buy tractors, attach trailers, hire drivers, keep the wheels turning, and collect money every time freight reaches a customer. The attraction is obvious because almost everything people buy has to move somehow. But transportation demand does not protect the owner's profit. This breakdown will show what the fleet costs to establish, how freight revenue is created, where the cash disappears, and what separates controlled growth from expensive motion. A truck can stay busy while the business behind it struggles. Because the same machine that creates revenue also consumes fuel, labor, maintenance, insurance, financing, compliance, and working capital every mile it travels. The ownership question is not whether trucks are necessary. They are. The real question is whether the rate you collect for moving freight stays above the complete cost of moving it, including the miles when the trailer is empty and the days when the truck earns nothing. That distinction matters more now than it did during the pandemic freight boom. ITRE's 2026 operating cost study put the industry average cost of operating a truck in 2025 at $2,336 per mile, the highest level in that report's history. It also found truckload and refrigerated operating margins still below 1%, despite carriers cutting capacity and staff. So the modern trucking fleet business is not a simple volume game. More miles can mean more revenue, but they can also mean more exposure to fuel prices, repair cycles, driver turnover, insurance claims, and bad freight. A profitable fleet is built by controlling the spread between revenue per total mile and cost per total mile. That is the number that eventually decides whether the owner is building an enterprise or merely financing motion. Before we go deeper, this channel looks at ownership economics rather than just the attractive surface of a business. The goal is to understand what the asset costs, how it earns, where the cash goes, what can break the model, and what an owner has to manage when the business scales. Trucking is a perfect example because the physical operation is easy to see, while the financial system underneath it is mostly invisible. Start with equipment. A fleet owner can buy new tractors, used tractors, lease equipment, or combine several approaches. There is no single national purchase price that safely represents every Class 8 tractor because model, sleeper configuration, powertrain, emissions equipment, age, mileage, warranty, and financing all matter. The same is true for trailers. A dry van, refrigerated trailer, flatbed, tanker, and specialized trailer are different businesses attached to different capital requirements. That means the correct starting question is not, what does a truck cost? It is, what equipment does this freight contract require? What will that equipment cost to own over its useful life? And what happens if it is unavailable? Used equipment can reduce the check written on day one, but it can shift risk into the maintenance budget. A lower purchase price is attractive because it reduces the amount financed. The danger appears when high-mileage components begin failing close together. Engines, after-treatment systems, transmissions, cooling systems, suspension, wheel ends, electrical components, and tires do not care that the owner got a bargain at auction. A fleet that buys older equipment without a realistic repair reserve can become undercapitalized immediately. The truck may be cheaper to acquire and more expensive to keep available. Availability is what matters because a parked truck has many costs and almost no operating revenue. Newer equipment creates the opposite trade-off. The acquisition price and monthly payment can be higher, but warranty coverage, predictable maintenance, fuel efficiency, and fewer major breakdowns can improve planning. That does not make new equipment automatically better. A large payment on a truck running weak freight can be more dangerous than an older paid-down tractor with disciplined maintenance. Trucking ownership constantly forces this kind of comparison. Cheaper asset versus more downtime, newer asset versus more debt, lower fixed cost versus higher repair uncertainty. Then comes legal authority and compliance. A new interstate for hire carrier may need a U.S. DOT number and the appropriate FMCSA operating authority, depending on the operation. FMCSA currently charges a one-time $300 filing fee for each operating authority requested. Carriers subject to the Unified Carrier Registration Program also pay an annual fleet size-based fee. For 2026, the smallest 0 to 2 vehicle bracket is $46. Heavy highway vehicles at or above the federal taxable weight threshold can trigger Form 2290 filing and heavy vehicle use tax obligations, with the amount depending on taxable gross weight and, in some cases, mileage. These are only part of the stack. State registration, fuel tax reporting, insurance filings, permits for certain operations, Drug and alcohol program obligations, and record keeping can all apply depending on how and where the fleet runs. Hours of service rules also shape the economics. For property-carrying drivers, FMCSA generally allows up to 11 hours of driving after 10 consecutive hours off duty, inside a 14-hour on-duty window. Most drivers who must maintain records of duty status are also subject to electronic logging device requirements unless an exception applies. These rules are safety requirements, but they are also capacity constraints. An owner cannot solve a late load by simply ordering a driver to work indefinitely. Driver time is finite, and poorly planned waiting time at shippers can consume legal hours without producing paid miles. Insurance is another threshold cost. Because an interstate for hire property, carrier cannot simply decide to operate uninsured. Federal financial responsibility requirements set minimum liability levels for covered operations, and the actual policy cost can be much higher than the legal minimum would suggest. ATRI reported in 2026 that liability premium costs rose 18.6% per mile from 2021 through 2024, reaching 10.2 cents per mile in its study sample. That is an industry benchmark, not a quote for a new carrier. A small fleet's actual premium can vary sharply with geography, cargo, limits, claims history, driver records, equipment, operating radius, and insurer appetite. That is why one unsafe hiring decision can create financial damage long after the driver leaves. A fleet owner is not only buying trucks. The owner is underwriting people. Every driver added to the payroll changes the company's safety exposure, insurance profile, service quality, fuel consumption, maintenance behavior, customer reputation, and legal risk. The driver who protects equipment, communicates early, avoids preventable incidents, and stays with the company can be worth far more than the difference between two freight rates. The driver who creates repeated violations or claims can erase that difference. Labor also has to be viewed as a full compensation system rather than a simple paycheck. BLS reported a 2025 median annual wage of about $60,320 for heavy and tractor-trailer truck drivers in truck transportation. A carrier's actual labor cost can exceed the wage itself because payroll taxes, benefits, recruiting, onboarding, training, bonuses, workers' compensation, downtime between hires, and administrative support all matter. Some fleets pay by mile, some by hour, some by percentage, and some use hybrid systems. Now add fuel. Diesel is one of the most visible costs because the owner sees it every day, and it can move quickly. EIA's weekly U.S. on-highway diesel data showed prices around the upper 4 per gallon range in July 2026 after significant volatility earlier in the year. A fleet cannot control the national diesel market, but it can control purchasing discipline, route selection, idling, speed policy, tire pressure, equipment specification, and whether customer contracts include fuel surcharge mechanisms. The difference between buying fuel strategically and buying it wherever the truck happens to stop becomes meaningful across millions of fleet miles. Maintenance is less predictable. Failures arrive when they want. A truck can leave a shop with fresh fluids and still lose an alternator, wheel seal, sensor, air conditioning compressor, starter, or emissions component hundreds of miles later. Larger fleets can sometimes reduce repair costs through in-house technicians, parts inventories, preventive maintenance systems, and buying power. Smaller fleets often depend on outside shops and roadside service, which can mean higher labor rates and less control over repair timing. The true cost is not just the invoice. It is the lost contribution from the load the truck could not haul. This is where revenue has to be measured correctly. A freight rate is usually quoted around a loaded movement, but the truck's cost meter does not switch off when the trailer is empty. Suppose a simplified planning model shows a load paying $2,900 for 1,000 loaded miles. If the truck must travel 150 empty miles to reach the pickup and another 100 empty miles after delivery before the next useful load, the truck actually traveled 1,250 miles to earn that $2,900. The gross revenue per total mile is $232, not $290. Against a benchmark operating cost above $230 per mile, that seemingly strong load has almost no room for error. This is only an educational model, but the principle is real. Deadhead converts attractive loaded rates into weaker total mile economics. ATRI found average empty mileage at 16.7% in 2024, and its 2026 report said deadhead remained elevated in 2025. That is why network design becomes a competitive advantage. A carrier with dense customer relationships can pair outbound and return freight, reposition trucks intelligently, and reject loads that create expensive empty movement. A small carrier depending heavily on open market freight may have fewer choices. The owner can negotiate a good loaded rate and still lose the week through poor positioning. The same problem appears with detention and dwell. A truck waiting at a dock is using equipment, driver time, insurance, and working capital while producing little or no movement. If the delay consumes legal driving hours, the truck may also miss the next appointment. Sophisticated fleets measure customer dwell, lane performance, on-time service, empty miles, fuel burn, maintenance intervals, and revenue per tractor because a bad customer can be expensive even when its rate looks respectable on paper. Dedicated contracts can improve predictability, but they do not eliminate risk. A multi-year shipper relationship can stabilize volume, improve route planning, and reduce dependence on the spot market. In exchange, the carrier may accept tighter pricing, service commitments, penalties, specialized equipment, or fuel surcharge formulas. The best contract is not automatically the one with the highest headline rate. It is the one whose total economics work after empty miles. Waiting time, seasonal volume, accessorial payments, payment terms, and equipment requirements are included. Spot freight offers flexibility and sometimes attractive pricing, but it exposes the owner more directly to supply and demand. The pandemic years demonstrated how quickly freight markets can move. Strong goods demand and capacity shortages pushed rates upward, carriers added trucks, and new entrants arrived. When goods demand cooled and capacity remained, rates fell while many costs stayed high. ATRI's 2025 report on 2024 operations measured average truckload operating margin at negative 2.3%. The 2026 update showed improvement, but truckload margins were still below 1% in 2025. That history matters because it shows why a fleet cannot base debt payments on the assumption that a strong rate environment will continue forever. Scale changes the equation, but not in one direction. A 10-truck fleet may get better fuel discounts than a 1-truck operator, spread office overhead over more revenue, negotiate more seriously with shippers, and keep a spare tractor available. A 100-truck fleet can justify dedicated safety staff, dispatch teams, maintenance facilities, recruiting systems, data analysts, and more sophisticated technology. At the same time, every additional truck adds capital exposure, another driver seat to fill, another insurance unit, another maintenance schedule, and another piece of equipment that can be sitting instead of earning. That is why fleet growth should usually follow proven freight, not precede it. Buying 10 trucks because a salesperson can finance them is not the same as having 10 profitable seats. The fleet needs drivers, freight, working capital, maintenance capacity, insurance approval, parking, dispatch coverage, compliance systems, and enough management attention to keep all of those parts coordinated. Growth can reduce unit costs and still destroy cash if the organization expands faster than its operating system. Consider an original planning example. Maya operates 8 tractors serving 2 regional manufacturers under contracted lanes. Her model assumes each tractor travels 105,000 total miles in a year, including empty repositioning. The contracts are modeled to produce an average of $282 in gross revenue per total mile after expected accessorial payments. That would create about $296,100 of annual gross revenue per tractor in the model. If her all-in operating cost is planned at $240 per total mile, annual operating cost would be about $252,000 per tractor, leaving roughly $44,100 before company-level taxes and any costs the model has not included. Across 8 trucks, that is about $350,800. These figures are not industry promises. They are a simplified illustration of how small changes in rate or cost become large changes in owner economics. Now stress the same model. If revenue slips by only 15 cents per total mile while operating cost rises by 10 cents, the spread narrows by 25 cents. Across 840,000 fleet miles, that change reduces annual operating contribution by about $210,000. Nothing dramatic has to happen. No bankruptcy, no catastrophic crash, no recession headline. A softer renewal, higher fuel, a few repair cycles, and weaker utilization can remove most of the cushion. That is why fleet owners watch pennies per mile. At scale, pennies become salaries, truck payments, and months of working capital. Working capital may be the least glamorous and most important asset in the company. Fuel is purchased before many freight invoices are collected. Drivers expect regular payroll. Insurance, equipment payments, permits, software, repairs, and taxes have their own due dates. Customers may pay on terms that leave the carrier financing operations for weeks. A profitable income statement can therefore coexist with a cash shortage. Factoring can accelerate receivables, but it has a cost and changes the economics. A line of credit can help bridge timing, but borrowing capacity is not the same thing as profit. This is also why the owner has to separate revenue, operating profit, cash flow, and personal income. A fleet can produce millions of dollars in annual sales and still have little cash available for distributions after fuel, payroll, debt service, maintenance, insurance, and reserve requirements. Money sitting in the account may already be committed to next week's payroll or next month's insurance installment. The owner who treats every positive bank balance as spendable profit eventually discovers the difference in the most painful way. A major carrier failure shows how scale does not cancel these rules. Yellow Corporation, a large less-than-truckload carrier with a history stretching back decades, filed for bankruptcy in August 2023. The company had also received a $700 million federal loan during the pandemic. Gao reported in 2026 that Yellow's bankruptcy estate ultimately repaid that loan in full. The useful lesson is not that one company proves trucking is impossible. It is that even a large network can become vulnerable when debt, operating performance, labor issues, customer confidence, and liquidity collide. Size gives a carrier tools, but it does not repeal cash flow mathematics. The strongest fleet owners therefore build management systems before they build impressive truck counts. They know cost per total mile by equipment type and lane. They separate planned maintenance from major capital repairs. They review customer profitability rather than only revenue. They track insurance performance and driver behavior. They know how much cash is required to survive a weak month. They measure empty miles and dwell. They understand which trucks should be replaced, which should be repaired, and which freight should be refused. Technology can help, but software does not rescue a bad model. Telematics, routing systems, maintenance alerts, fuel controls, dash cameras, driver scorecards, transportation management software, and automated billing can produce better information. The owner still has to act on it. A dashboard that shows a lane losing money is useful only if someone renegotiates the lane, changes the routing, or exits the freight. A maintenance alert is valuable only if the fleet creates shop capacity before the failure becomes roadside downtime. There is another ownership issue that smaller operators sometimes underestimate. The truck is both a productive asset and a depreciating machine. The accounting treatment, tax treatment, loan balance, resale value, and actual market value are not the same number. A tractor can be making every payment on time while still being worth less than the debt attached to it. That matters when the owner wants to replace equipment, sell the business, or reduce capacity. If the used truck market weakens at the same time freight rates soften, the fleet may discover that shrinking is expensive. Selling a truck can require cash instead of creating it. This is one reason a replacement schedule should be connected to mileage. Maintenance history, warranty status, expected resale value, and the freight contracts that support the asset, rather than to age alone. Cargo and customer concentration create another form of hidden leverage. A fleet with 80% of its revenue tied to one shipper may look stable because trucks are constantly loaded, yet one contract loss can create an immediate utilization problem across the entire network. The same concentration can appear in lanes. If most trucks end the week in a region with poor outbound freight, the carrier has built deadhead into the business model. Diversification does not mean accepting random freight everywhere. It means avoiding a structure where one customer, one lane, one equipment type, or one insurer can determine the survival of the company. Finally, not all revenue is equally valuable. Detention, layover, stop charges, fuel surcharges, refrigerated premiums, specialized handling, and other accessorial payments can materially change lane economics. A carrier that measures only base line haul revenue may misunderstand which customers actually contribute profit. Good accounting therefore follows the truck through the entire trip, not just the loaded portion printed on the rate confirmation. The final ownership question is therefore less about trucks than discipline. Can you buy equipment at a cost your freight can support? Can you recruit and retain safe drivers? Can you keep enough cash in reserve to survive slow-paying customers and unexpected repairs? Can you price total miles instead of admiring loaded rates? Can you expand without losing control of safety, maintenance, billing, and customer service? And can you refuse growth when the numbers do not justify another truck? A trucking fleet can become a durable business. It can also become an expensive collection of financed assets moving constantly while producing very little owner return. The difference is usually not one secret strategy. It is the combination of contract quality, utilization, cost control, safety, maintenance, working capital, and management depth. The truck is the visible part. The business is the system that decides whether each mile creates value. The figures in this discussion are educational benchmarks and planning examples, not guarantees. Equipment prices, insurance, fuel, taxes, registration, financing, freight rates, and regulations vary by location, fleet size, cargo, operating authority, and time. Anyone evaluating a real fleet purchase or startup should verify current requirements and build the model from actual quotes, contracts, and operating assumptions with appropriate help from a CPA, attorney, lender, insurance professional, and trucking industry specialist where needed. If the numbers still work after the optimistic assumptions are removed, then you are finally evaluating a trucking business instead of simply buying trucks.